Home prices across America could decline by as much as 30% in 2023. And in this video, I'm going to tell you the cities where the home prices are going to decline the most, because what you all got to watch out for right now as a home buyer or a real estate investor is the fact that the US housing market is still in the biggest bubble ever. And we know this because the ratio of home prices to income in America shows that right now that ratio is at the highest level it's ever been. And ultimately, for this price to income ratio to get back down to the long-term average in America, prices need to decline by 30%. And right now, Americans don't have enough money to afford to buy homes, which is why home sales and home buyer demand in America is at the lowest level in about 10 years. And that drop in demand has caused the beginning stages of this housing crash to take form. However, this is just stage one of the housing crash, everyone. We're only in the second or third inning. We have another 6 to 7 innings of housing crash baseball to play, especially in certain cities, like the ones in dark red on this map. These are the areas and the metros where home values are the most overvalued. In a place like Tampa, home prices could go down by 38%, according to my model that predicts home prices in America into the future. In Dallas, Texas, home prices could go down by 33%. In a place like Phoenix, they could go down by 31%. And as this video goes along, I'm going to get more into the details behind which cities are going to have the biggest crash, because if you're a home buyer in one of these cities, you do not want to be buying right now or in the first 6 months of 2023. Because if you do buy, it's very likely that prices will continue to drop and drop fast after you make your purchase. And what I don't want to happen, everyone, is for you guys to get seduced into thinking that somehow we're at the bottom of the housing crash and that prices won't go down by anymore, because a lot of people, a lot of institutional investors are now trying to spin a narrative that says we're at the bottom of the housing crash. Home builder earnings reports, their CEOs are all saying that we're at the bottom, things are going to move forward. The National Association of Realtors, they're saying we hit a bottom in home buyer demand. If you look at the stock market, real estate stocks have surged over the last 2 months. I'm starting to see this bullish sentiment take over the US housing market, which is very perplexing to me, because there's nothing in the fundamental data to suggest that you should be bullish. All that the fundamental data really says is that we have a lot more to go in terms of this housing crash, especially in a metro area like Phoenix, where we're looking at a metric called the price to earnings ratio in the housing market going back to 2007. And what concerns me about Phoenix right now is that the price to earnings ratio is 7.8. Now you could see that's down from a peak of 8.6 in June. So very clearly the housing crash has started in Phoenix. Prices are going down, making it more affordable, but really affordability is not going to return until we hit this yellow line, the average price to earnings of 5.4 over the last 15 years, which is going to require another 31% decline in home prices in Phoenix. Now, how about we do some other cities? What about Miami? Miami is a very scary housing market right now, everyone, because the price to earnings ratio is a massive 9.5, which means it's 34% overvalued. And in fact, the price to earnings ratio in Miami today is even higher than it was back in 2007 at the peak of the previous bubble before prices crashed by 50%. Another metro where we're seeing a similar story play out is Las Vegas. Las Vegas has an 8.4 price to earnings ratio. That means prices need to go down by about 26% to restore affordability. This would be when home buyers would return to the Vegas housing market once we hit this yellow line. And if I haven't covered your city yet, don't worry, everyone. I'm going to do a rapid fire round later in this video. We're going to cover 10 different housing markets and see how overvalued they are in rapid succession. But before getting into that, we need to talk about another aspect of the US housing market that I'm sure you guys notice as a home buyer or a real estate investor out there, and that is mortgage rates. The 30-year fixed mortgage rate in America right now is over 6%. It's gone down a bit in the last 60 days from a high of 7% down to 6%, but that is still a very high mortgage rate given where home prices are. And it's really that mortgage rate which is constraining affordability, right? When the mortgage rates go from 3% to 6% in a matter of a year, well, you know that people's income and wages didn't go up that fast, which means that quite literally, like, most of America cannot qualify for a loan to buy a house in today's housing market. And I'm going to show you a data point now that really speaks to this affordability crisis, as I'm calling it. And that data point is the house payment to income ratio, which is very simple, everyone. We add up what the mortgage payments, property taxes, and insurance costs are of you buying a house today, and we divide it by how much money the average American makes. And right now, that payment to income ratio is 42%. You can see that's improved a little bit in recent months with the decline in mortgage rates, but it's still way too high. The average over the last 25 years is 30% of your income going to your home ownership costs. That's kind of the rule of thumb you hear a lot out there, is if you are spending 30% or less, then maybe you should buy. If you're spending more than that, you shouldn't. So we're in the danger zone here. And what concerns me about this danger zone is, look, it looks very similar to the danger zone we had in 05-06 during the biggest housing bubble ever, where all those bad mortgages were made. The lack of housing affordability was similar back then to what it is today. And this has got to get you concerned, whether you're a home buyer, investor, or just someone who cares about the direction of the housing market and the overall economy. I mean, that's not a good graph I just showed you. And the more that we see these relationships of 2022 and 2023 looking like 2006 and 2007, that's really got to make you concerned. And this also speaks to an interesting topic, everyone, about foreclosures and mortgage defaults. I see a lot of people out there say this little narrative. They say that we're not going to have a bad housing crash because there's no bad loans. There's no subprime loans. Tell me in the comments if you've heard someone say that argument before, because there's this notion, a false notion, that all the loans being made today are good and that no one will really default and get foreclosed on as the recession gets worse. But we know that that's not true, everyone. During this recession in 2023 and 2024, there's going to be a lot of foreclosures, because if the payment to income ratios are around 40%, the same as they were in 06, that means that we will have a wave of defaults once the unemployment rate goes up and people start losing their jobs. And so that's a kind of crazy thing about this housing downturn so far, is that we've seen prices go down by about 5% across America over the last 7 to 8 months. In certain cities, like in Austin or San Francisco, prices are down 15%. And we've seen that happen without an increase in foreclosures. So think about that. The default rate right now and the foreclosure rate is at an all-time low, and yet we're already seeing home prices go down by a lot in certain cities. So what would that mean then for the future in 2023 and 2024 as foreclosures go up and increase and first get back to normal levels and then surge above normal levels as the recession takes hold? Well, I think you guys know what that's going to mean. It's going to mean that the housing crash is going to get even worse as the foreclosures get unloaded onto the market over the next 2 years. And where are these foreclosures going to be heaviest? Where are we going to see the biggest declines in price? Again, everyone, it's going to be the areas in red. And you can see that most of America is red because most of America is in a housing bubble. But we see a lot of red, especially in the Southeast, markets like Charlotte, Atlanta, Florida. We see a lot of red in Texas. We see basically the entire western half of America, a market like Denver or a place like Riverside, California, or Sacramento, California, is in red. And this is where the crash is going to be most severe and where we're going to see a lot of foreclosures in these areas in red. Now, interestingly, certain markets like the ones in blue are not tremendously overvalued. And I'm going to get into these markets in blue in another video down the line so you can understand the cities that won't crash in America. Because yes, there are some cities that are not going to crash. And if you go back to 07 to 2012, during the biggest housing crash of all time, there were certain cities like Pittsburgh, like an Oklahoma City, like a Wichita, Kansas, that did not have declines in value in the biggest housing crash of all time 15 years ago. And there's also going to be cities this time around that don't crash as much. But the fundamental expectation should be, in most parts of America, that prices will decline in 2023, and they will start to accelerate those price declines as the year goes along, because we're dealing with like a whole host of headwinds for the housing market. I mean, folks, let's just count them down. Number one, we have high mortgage rates combined with record high home prices and an utter lack of affordability. But then number two, we have a huge backlog of home building, 1.7 million homes actively under construction. They're going to get delivered in 2023 into an economy that's either in a recession or on the doorstep of a recession. Combined with number four, the foreclosures that are coming that we talked about before. I mean, do the math on that, folks. Values are going down across America in 2023, but I don't know if we're going to see 30% declines in the calendar year. I think it's more likely we see something like a 10% decline in home values in 2023, followed by a 5% decline in 2024, followed by another 5% decline in 2025. Because the thing to understand about housing crashes is that they are what I call slow motion crashes. They take time to play out. That last downturn from 07 to 2012, that took 5 years. All those regional housing crashes we had in the early 90s in California and New England, those took 5 to 6 years to play out. So if you're a home buyer today in 2023, mentally prepare for that. Understand that you're going to be seeing more affordability and better deals as the year goes on, but then also understand that we are still likely in the beginning stages of a multi-year housing downturn that's going to take time to play out. And ultimately, what you need to do as a home buyer or investor is decide what you want. Like, are you just desperate to get into a house? Have you been waiting 3 years? Well, then maybe you'll jump at the first good price cut you see in a house that you like and you'll buy it and you won't care about prices going down another 20%. You need to figure out, what kind of home buyer you are. For example, if you're a home buyer looking in the Charlotte, North Carolina housing market, you're going to see that price to earnings ratio today is 6.9. It's coming down a little bit from its highs over the summer, but we're still so far above the long run levels of affordability. We're so far above where Charlotte was in the previous bubble that I think prices could go down by 36%. So just understand, over 4 or 5 years, prices in Charlotte could go down by that much. So if you buy in 2023, you might get a discount, but then prices could go down by more in 2024 and 2025. How about if you're a home buyer in a market like Seattle, Washington? Well, the PE ratio in Seattle is 10.4. That's very high, folks. You can tell that's the highest one we've seen so far. Home prices of $749,000 in Seattle are 10 times higher than the average worker wages of $72,000. Now, that's 33% above the long-term average. And again, it's higher than it was in 07, which has got to scare you, which means Seattle's in for a long, drawn-out, brutal housing downturn, in my opinion. Now, what about if we were to actually look at a housing market that's even more expensive than Seattle? Think about one of the most expensive cities in America to live in. How does the housing market look in a city in metro like LA? Well, the price to earnings ratio in LA is 14x. It's off the charts, but as you can see, LA is always expensive. The long-term price to earnings ratio is 11.8, suggesting about 15% downside in values in Los Angeles. However, I personally think prices in Los Angeles and several other cities are going to go down by even more than my model suggests. And that's because there's actually a flaw in my home price model, and that's that it doesn't take into account one really big aspect of a housing crash, and that's how big the local economic recession is. There's clearly, job losses and layoffs. That's going to have a big impact on the housing market in addition to affordability. And I think markets like Los Angeles, San Francisco, Boston, San Jose, Denver, Austin, these expensive tech-driven housing markets, they could be in for years and years of layoffs, years and years before we see job growth really start to accelerate again. And that could make the housing downturn in those cities even worse than my model projects. So that's something to make sure to also think about, is the economic risk factors that are inherent in your city, in your housing market. Now, I'm going to do a couple more cities here before I get going, everyone. But before that, I want to let you all know that if you guys like this data and you want to access it for yourself, you can. All you need to do is hit the join button below here on YouTube and become a channel member of the ReVenture Consulting channel. The cost is $5 a month. And for that $5 a month, you get access to a lot of exclusive data and graphs on my Tableau public profile. You can see it here on the screen in front of you. Data on price to earnings ratio, data on inventory and price cuts. Make sure to hit the join button below and turn your notifications on so you can get the posts and the emails when I send them. Finally, everyone, let's do a couple more cities here on this map before signing off. I want to point you all to Idaho first off. We talked about Boise before at 33% overvalued, but markets like Twin Falls and Idaho Falls are over 40% overvalued. Absolutely unbelievable. If you go up to Missoula, Montana, Billings, Montana, the area around where they filmed Yellowstone, you can see they're 30% overvalued. The entire state of Washington pretty much is 20 to 30% overvalued. Really, the only area where there's some level of affordability still are parts of the Midwest, everyone. Parts of the Midwest, like a Chicago, is only 12% overvalued. A Cleveland is only 17% overvalued. If you had to buy in any city right now, it'd probably be these areas in the Midwest because there's more affordability. As well as additionally, everyone, New York, only 15% overvalued according to this data. I thought it would have been more than that. And with that, everyone, this is Nick from Reventure Consulting signing off. I'll see you next time.